Welcome to the InterMarket Analysis video update. This is a video that I do once a week where I not only look outside the S&P 500 at other stocks within the stock market, we also look into other markets to see if we can get any insight as to what's happening inside the S&P 500. This is being prepared from Monday, June 5th. The first area that we look at is called valuation. What we want to look at is on a historical basis as well as a forward-looking basis. Is the stock market considered to be expensive, fairly valued, or cheap? The first chart that we look at has a PE ratio of 20. 20 and above means that we're expensive. Anywhere from 11 to 19, we're fairly valued. 10 and under, we're considered cheap. We can see up here at the top where the black line is the S&P 500. The red line, which is the 20 PE ratio, we're well above that level. So on a historical basis, we are considered to be expensive. We can also look at this over time, going back to 1980, different events that have happened in the market and what the valuations were at that time. We also look at a thing called the Shiller PE ratio. It's giving us a reading of 29.97. The median and the mean for this indicator is between 16 and 17. So also, looking backwards, we're also considered to be expensive. But the market doesn't do that. They look forward. On a forward-looking PE ratio basis, as of Friday, we are at 18.6 with the S&P 500. We're underneath 20, but we're above 15. When we look at the mid caps, we're under 15 at 13.3. And with the small caps, we're also under 15 at 13.2. So this is considered on a forward-looking basis that the S&P is a little bit under being expensive, where the small caps and mid caps are under being fairly valued. We also look at a thing called current market valuation. This is a composite where you take a lot of different calculations, show them as charts, and then put them together as one score to see if the market is fairly valued or overvalued. We're getting near the point where we're still fairly valued right now, but we're getting to that overvalue situation. Here's a historical chart showing how this aggregate score has performed over time, where we're getting above this one standard deviation. When we go above this yellow line, that means that we are overvalued. Now we break this down a little bit. The Buffett indicator model, we're above the one standard deviation, so that is overvalued. The price to earnings model is also above the one standard deviation. That's overvalued. When we look at the interest rate model, that is still fairly valued. The mean reversion, how far do we get away from the mean or average price? We're getting kind of far away from that, above the one standard deviation, so that is overvalued. Then we look at the yield curve model, which is also very high, mainly because we have a lot of the yield curves that remain inverted. Then we look at the state coincidence index model. How likely are we to go into a recession? That's still pretty low right now. Then we look at margin debt. That is neutral. We're underneath the historic trend line. And then the junk bond spread is also neutral. We're underneath the historic trend line. Then another area that we look at is growth versus value. Growth is when we see prices really go from low to high. You want to buy a stock at 10, sell it at 20. That's a growth stock. If you have a value stock, it may not move all that much as far as its price, but it may be more of an established company. They may pay dividends. They may have stood the test of time. First, we look at the peer growth index, which continues to be in an overall downtrend, but it has been showing some improvement. We look at the value index, which had been doing really well in 2022. It's starting to go into a downtrend now in 2023. Now we compare the two, growth versus value, where growth is just starting to give us a golden cross within the ratio. Now individually, both growth and value are in downtrends, but when you compare the two, growth is starting to outperform value. We have a flip side of that same chart where value is now starting to underperform growth. Then we look at this a number of different ways. We look at some ETFs comparing growth versus value. We're starting to see almost a golden cross here with this ratio between growth and value. This is an inverse of that same chart where we're also starting to see a death cross with value to growth. Then we look at some indexes where we're seeing a golden cross here with growth starting to outperform value. And then here is where value is now starting to underperform growth. Then another index that we look at compares these two, showing that growth is now outperforming value. One area that we're really watching these days are the small caps and the mid caps. If you look at the index, here's the small cap index where it's clearly in a downtrend, even though it had a real good day on Friday. That would suggest that small caps are very weak right now. But when we look at growth versus value inside of the small caps, ever since the beginning of November or so, we've been seeing a really strong uptrend where growth is outperforming value. This could indicate that the smart money is buying on weakness, thinking that prices are going to go higher into the future. We're also seeing that same type of thing with the mid caps, where the index overall has really run into some trouble, especially after the beginning of 2023. We are seeing growth really outperforming value, which could suggest underlying strength. We also look at growth versus value, which is really starting to improve on this chart, and value is really starting to underperform. Then we look at the S&P growth versus value, and since the beginning of February, growth has been doing well, but we've been chopping sideways to slightly declining as of late. Looking at some inflation gauges, we have the CRB index on top. This is a monthly chart where it's in an overall downtrend. We also show that the inflation to deflation ratio continues to fall. We look at the Baltic Dry Index. How much does it cost to ship products from one place to another? This also continues to be in a downtrend. And the CRB, which we also use to keep an eye on inflation, is also in an overall downtrend. Some other markets to look at. Here's aluminum going down, corn is going down, wheat is going down, fertilizer continues to fall, oil has been chopping around the 70 level in a downtrend overall, gas has been going in a downtrend, heating oil's down, natural gas is down, diesel continues to fall, lumber is also in an overall downtrend, copper is still in an uptrend but showing a lot of recent weakness. We keep an eye on copper because if copper's going up, that tends to mean that the economy will be stronger going into the future. As it's going down, that means that the economy looks to be weaker into the future. Gold is still in an overall uptrend, even though it's seen some recent weakness. Then we compare copper to gold, and we make a ratio of that, where copper has been underperforming gold, even though it's been bouncing back up lately. Then we look at a longer-term chart of that same thing, and I've added the 10-year yield on here, where we usually look at the 2-year yield. We show the copper to gold ratio really going down as interest rates have been pretty much chopping sideways. There's still a really wide spread between the yields and the copper to gold ratio. Silver is also in an overall uptrend. Then we look at gold and silver and then do a correlation on the bottom where they have a real strong tendency to move in tandem with each other. And then we look at the gold to silver ratio and compare it to what's happening in the dollar. As a general rule, when the US dollar is going up, gold outperforms silver. Okay, lately the dollar's been doing a little bit better. So that means on a shorter term basis, gold is outperforming. When the US dollar index is going down, silver outperforms gold typically. And when the dollar was really going up, we saw gold doing well. When the dollar is going down, we see silver starting to outperform. And then at the bottom, we see where the ratio has a really strong correlation to the US dollar index. The dollar itself is still in an overall downtrend, but it has been trying to bounce back up. Then we look at the euro compared to the dollar, where the euro's been coming down lately and the dollar's been showing a little bit more strength. We also look at the Japanese yen, which is still in an uptrend, but seeing some short-term weakness compared to the dollar. Here's an independent chart of that showing how the Japanese yen is in an overall uptrend against the dollar, but showing some weakness. Here's the British pound, which is also in an uptrend compared to the dollar. Some index ratios, and I point this out in the daily video. The equal weight index, even though it's showing some improvement here, continues to underperform the S&P 500. There are times when we can look back when the equal weight index was outperforming, and that suggests a lot more strength. The fact that it's underperforming here could give us some warning signs that there's underlying weakness. Then we compare the S&P 500 to the CRB index, where the S&P is outperforming. Here's an inverse of that same chart showing how the CRB is underperforming. The NASDAQ 100 to the S&P 500. The NASDAQ 100 has just been going up strong, and we've had a golden cross here in this ratio. The S&P 100 is outperforming the S&P 500. Those are the bigger stocks compared to the rest of the S&P 500. The small caps continue to underperform the S&P 500. In a good, solid environment, we want to see small caps doing well. The NASDAQ 100 is really outperforming the rest of the NASDAQ, and the NASDAQ is also outperforming the S&P 500. I look at this every day. This is a study about advanced decline lines where the NYSE is coming back up to its moving average. The S&P got slightly above its moving average, seeing a little bit of improvement with the mid caps, and we're coming back up to the moving average with the small caps. Then we look at the 30 biggest software companies. They are in an overall uptrend. We look at mega cap growth. These are the real big companies. They're just moving up really fast. Then mega cap growth to the equal weight index shows the mega caps are really outperforming. And then here's a newer one where I take a robotics and AI ETF, and that is really doing well overall. But then we compare it to the tech sector, and it's just going sideways more or less. It's not outperforming the regular tech sector. We look at the Dow Jones Composite Average, which is the Dow, transports, and utilities. They're going sideways, but they're still in an uptrend. Low volatility stocks, which did well in 2022, they're starting to show some weakness. We could see a death cross here with this ETF. And the low volatility stocks are really underperforming the S&P 500, and we've seen a death cross in this ratio. FANG stocks continue to do really well. ARK is still in a downtrend overall. It's trying to bounce back up a bit. And then we look at Dow theory. This is a daily chart showing how the Dow came back up to recent highs, but the transports did not confirm that. They were showing a lower high. And then on a shorter term basis, we're showing the utilities with some recent weakness. That is more of a short-term negative divergence. Now we take a new look at Dow theory where the S&P is breaking out above 4,200 and looking more positive. The NASDAQ is also breaking out. Then we compare the S&P 500 to Europe, Australia, Asia, and the Far East. We look at a monthly chart here where we're still above the moving average, and the PPO is starting to turn back up. So this is switching back more positive. Looking at bonds versus stocks, the total bond ETF continues to be in an uptrend. The Pring World Bond Index is really chopping around, but it's also in an uptrend. The stock to bond ratio shows that stocks are outperforming bonds. And here, bonds are underperforming stocks. High yield bonds, which means junk bonds, they're still in an uptrend, where the investment grade bonds are also in an uptrend. The stock to bond correlation, they're kind of near neutral, but they're having a slight tendency to go in the same direction. The Dow Jones Corporate Bond Index continues to be in an uptrend, even though it's been chopping sideways. The 10-year yield is right now at 3.691%. Then we look at the S&P 500 compared to the rise in interest rates. Finally, back in May, we saw the S&P starting to outperform the rise of interest rates. Here's the 10-year Treasury yield at 3.691 again, and the 30-year yield's at 3.88%. Junk bonds continue to be in an overall uptrend, and when we compare junk bonds with government bonds, junk bonds are outperforming. Looking at a daily chart of the yields, where we have been coming up, drop back down. Well, in Friday's session, they went back up. Then a weekly chart internationally, we look at the US, UK, and Germany. They are dropping over the week. Japan is its own little story that we're keeping an eye on. Then we look at the 5-year yield and do a study of that, where we're above the trend line on the chart. The short term is turning back more positive, meaning the 5-year yield's going up. In the intermediate term, we're still pretty much negative, and we're also negative in the long term. Then we compare the 5-year yield with the special K. That's still in an overall downtrend, but if you look at the KST, it's starting to go in an uptrend, so we're seeing a little bit of confusion on this chart. Then looking at the long-term bond ETF, short term it's declining, intermediate term it's flat, we're still positive in the long term. Then comparing the price of the 30-year bond to the CRB index and then coming up with a ratio, bonds are starting to outperform the CRB index. But if you look at the price chart, we're actually below a declining moving average. So again, we're seeing some mixed signals here. Then we look at the MOVE index, which measures bond volatility, and it's been coming down lately. Then we measure the volatility of stocks. That's the VIX on the bottom. And that's been really dropping off, and there's a really strong correlation between these two indexes. Then we compare the 3 to 7 year bond with the S&P 500, showing that bonds are underperforming. Taken another way, that means the S&P is outperforming. Here's some newer charts where we look at riskier bonds and then compare them to more conservative bonds. We're still inside the rainbow overall with this, meaning that they're showing some improvement, but folks aren't quite ready yet to get into the riskier bonds. Why do they do that? Well, they give a higher return, and so when people feel positive about things, they're more willing to take on more risk. Then we look at the S&P 500 with a shorter term bond ETF, and this is showing that the S&P is outperforming. Then we look at a broad market ETF and compare it to bonds. This is also suggesting that the broader market is outperforming bond prices. And then we look at the tech sector, which is really outperforming bond prices. And now we look at the S&P 500 against different sectors. The materials sector is really underperforming the S&P. Communication is outperforming the S&P. Energy, we just saw a recent death cross with this ratio, and that's negative. The financials continue to be negative. The industrials are underperforming the S&P. Tech is really outperforming the S&P. The staples are really dropping off compared to the S&P. Real estate is underperforming the S&P. Utilities are also underperforming the S&P. We look at the S&P 500 to utilities ratio where the S&P is starting to outperform. If you compare this chart down below with the price action of the S&P, a lot of times when this ratio is going up, that gives good support to the S&P itself. Healthcare is also underperforming the S&P. Here's another look at healthcare where we have seen a recent death cross with this ratio. Discretionary, still chopping more or less sideways, and it's underperforming the S&P but showing some improvement. The staples sector is still in an overall uptrend, but we're starting to see some weakness. The tech sector is really looking a lot stronger. And when we compare the tech sector to the S&P 500, it's really outperforming. And the semiconductors are also doing well right now. We compare energy to tech. Energy is underperforming tech, where in 2022 we saw just the opposite. Growth, meaning growth stocks, and then comparing them to government bonds, growth stocks are starting to really outperform bonds. Looking at the tech sector and the rise in interest rates, where the tech sector is now outperforming. The opposite of that shows that the rise in interest rates is going down more than the rise in technology. We compare discretionary, which means growth, with staples, which means more value, where discretionary is still in an overall downtrend, but it is showing some improvement. And then we look at an inverse of that, showing how staples are still in an uptrend, but showing some weakness. We compare gold to the S&P 500, which is in an overall uptrend, but gold is really choppy. And then we look at the gold to dollar ratio. We came right up to this downward sloping trend line, have now bounced back down. And then here's another look at InterMarket Analysis, where this just goes back to the beginning of 2023. Stocks are in first place, followed by gold, and then bonds, and then the dollar, where energy is now negative on the year. We look at high leverage loans. Again, these are considered to be risky, and if we thought the economy was really going to run into trouble, this index would not be going up the way it is. And then we compare small caps with the S&P 500. They are really underperforming. We want to see this red line turn and go up, and a lot of times that gives good support to the blue line, which is the S&P. The NYSE composite going sideways overall, but still in an uptrend, and the Wilshire is also still in an uptrend. All stocks continue to be in an uptrend. Emerging markets chopping sideways, but still in an uptrend. Bitcoin still in an uptrend, but we're seeing some recent weakness as it's been falling below 27,000. Then internationally, we're in a downtrend in China as well as the emerging markets, starting to roll over in Europe, and a downtrend in Japan, trying to turn back up with the S&P 500. Looking at some correlations, we compare the S&P to the dollar. They are neutral currently. Then we compare the S&P to oil, having a slight tendency to go in opposite directions. The S&P to the 10-year yield, a little bit more towards neutral, but a slight tendency to go in opposite directions. Comparing the tech sector to the 10-year yield, they are pretty much neutral. The S&P to the 2-year yield, after being neutral, is starting to go in the same basic direction. Then we look at the home builders, and I go through this in every daily video, where the S&P broke out on Friday. The home builders were strong. The ratio showed some improvement, and they still have a really strong correlation. What we look for in this chart are divergences, either positive or negative, and we're really not seeing any right now. Then we look at the long-term secular and cyclical trends. This is the NYSE composite of a monthly chart with the Copic curve plotted down below, where the Copic curve is turning back up, and we're starting to go above the moving average here, even though that moving average is declining. Then we also look at the NYSE with a thing called the NYSE Record High Percent Index. That is showing some improvement. And the S&P to the PPO, that is also positive longer term. And then we compare the S&P to the CRB index, where the S&P is outperforming. And the S&P to the global index on a monthly chart, we're above the moving average up above, but the KST is still declining down below. So what's positive as of right now? Now, I define positive as the 50-period simple moving average being above the 200-day moving average, the dynamic software, the biggest software companies, the euro, the Japanese yen, and the British pound against the dollar, copper, gold and silver, the mega caps, low volatility. Even though we're seeing some weakness there, we haven't crossed over negative yet. The Dow Jones Composite Average, even though it's chopping sideways. The FANG Index is doing really well lately. All the different bonds, even though they've been chopping sideways lately, the ETF that we look at, the high yield, the investment grade, the world bonds, the corporate bonds, and the junk bonds still remain in overall uptrends. The staples, even though they've seen some weakness, they're still in an uptrend. The tech sector and semiconductors are going up. The high leverage loans continue to do well. The Dow, the NASDAQ, and the NASDAQ 100, the NYSE, as well as the Wilshire, all stocks, emerging markets, and then finally Bitcoin are all in overall uptrends. Looking at the negative side, this is when the 50-period simple moving average drops below the 200-day simple moving average. The growth indexes, as well as the ETFs, the value indexes, they're both in overall downtrends, but growth is starting to outperform value. The CRB index, the US dollar, ARK, and micro caps, small caps, and mid caps continue to be in an overall downtrend. So thank you. I hope you found this useful. Please feel free to check out the daily videos, and I also just posted a weekly video. After this, I'll be preparing what I call the deep dive video, where I go through all the daily charts and talk about the charts that I really didn't use that much in this week's videos. Have a great weekend, and I will talk to you in the next video.